candle, the 1 hour candle, 30-minute candle, 15-minute candle, whatever candles there are. So in this section, we're going to talk about how different sessions, they influence different time frames. Now, before we get into the depth of that, we have to understand this one thing. When do we have big candles forming, right? What are the times when we have big candles forming? Because as we've discussed before, the bigger candles are only going to form when there's going to be volume in the market. Let it be the 4-hour candle, the 1-hour candle, 30-minute candle, 15-minute candle, whatever candles there are, right? The bigger candles are only going to form when you have volume in the market. We have to understand this one thing. So now, what we're going to talk about is going to be the 4-hour candles, and we're also going to talk about which sessions influence the 4-hour candles, because the 4-hour candles obviously have to be bigger. And we've also talked about that whenever you're trying to take a trade, you have to make sure that a candle is going to be a bigger candle. If you're missing out on those trades, you have to understand that, okay, when did this big candle form? Did this big candle form because there was volume in the market? Did this big candle form because there was a market open, pre-market open? Was there any news events at that time? Was there any, breaking news happening? Sometimes you're going to have bigger candles form when there's going to be no volume in the market, right? Before the market opens, before even the pre-markets open, that's going to happen. So once we get into this, you're going to understand that how sessions are going to influence your time frames. And specifically, we're going to talk about the 4-hour time frames. Okay, to start this off, we know that there are 6 4-hour candles in one daily candle. So we're going to write them down right over here. So we have the first 4-hour candle, 1, 2, 3, 4, 5, and 6, right? So we have 6 4-hour candles, and these 6 4-hour candles, they make the overall daily candle, right? Now, whenever we're looking at the 4-hour candles, we understand that not all 6 4-hour candles are going to be bigger candles, because, some 4-hour candles are going to be smaller, some 4-hour candles are going to be bigger, right? And we also understand that if we have one daily candle, which looks like this, a bigger one, we understand that maybe there were only like 2 4-hour candles that made the daily candle bigger. Maybe there were 3 4-hour candles that made the daily candle bigger. So these things we have to understand. So we're going to talk about which sessions influence these 4-hour candles. Now, let's take a look at the first one. Now we need to understand when this first 4-hour candle starts. The first 4-hour candle normally starts at around 5 p.m. and goes till 9 p.m. Eastern time, right? We're only talking about Eastern time right here. The first 4-hour candle starts at 5 p.m., goes all the way up towards 9 p.m. Eastern time. Now, we have the second 4-hour candle. Now, once we're looking at the first one, which sessions fall in this first 4-hour candle? It's very simple. Which sessions fall in the first 4-hour candle? It's your pre-Asian and your Asian open. These are the 2 sessions that fall in the first 4-hour candle. Now, sometimes we do have the 4-hour candle, the first one, which is a bigger candle, right? That's when we can say, okay, maybe in the Asian session there was a lot of volume, and maybe that volume really pushed the 4-hour candle. Now, next 4-hour candle, it starts at 9 p.m., goes all the way up towards 1 a.m. Eastern. What's this time? Do we normally have volume during this time right here? Do we have volume during this time? Probably not. We don't normally have volume at this time. So normally, most of the times when you take a look at your charts, you're going to understand that this 4-hour candle is mostly a small candle, right? A small candle because there's no volume at that time. The 1-hour time frames are consolidating. The 30-minute time frames are consolidating. That's why we always talk about that. Always make sure you're taking a trade when there's volume in the market, right? After this, we have the next 4-hour candle, and this 4-hour candle starts at 1 a.m., goes all the way up towards 5 a.m. Eastern. Now tell me which session falls in this 4-hour candle. You have your pre-London. So in this session right here, in this 4-hour candle, you have your pre-London and your London open. These are the two sessions that fall within this 4-hour candle. So normally when you're going to take a look at this 4-hour candle around this time, you're going to notice that this 4-hour candle is going to be a bigger candle. It's regardless the fact that maybe the 1-hour candle printed the 4-hour candle bigger, or one 30-minute candle made a 4-hour candle bigger, but the fact is that most of the time during this time right here, 1 a.m. and 5 a.m., you're going to see that the volume is going to be in this 4-hour candle. So the point is, when you're trying to make a trading plan, right? Whenever you're trying to make a trading plan, you have to choose that which time frame you're going to choose to trade. This is very, very, very important. The most important aspect. Next, we have from 5 a.m., we have 5 a.m. all the way into 9 a.m. Eastern, we have another 4-hour candle. Now you need to understand that which session falls within this 4-hour candle. And the answer is simple. You have your pre-New York and you have your New York Open. You have two sessions, high volume sessions, but also don't forget that these two 4-hour candles are the most volatile 4-hour candles. The most amount of volume that's in the market lies between these two 4-hour candles. And sometimes, like, you know, there's a lot of volume in this 4-hour candle as well. So let's talk about that here first as well. So this 4-hour candle, we have 9 a.m. going all the way towards 1 p.m. Now, which sessions fall in this 4-hour candle? Let's talk about that. We have the NYSE Open, and we have London Close in this 4-hour candle. Let's talk about the last one, this last 4-hour candle. We have from 1 p.m. all the way till 5 p.m. And normally there's not enough volume in this 4-hour candle. So because, you know, price is consolidating, London is closed, Asian is closed, we're coming up to a close of the New York session. So normally there's no volume, and normally I don't see anyone trading at this time. So the only bigger volume time frames, or the only bigger volume sessions we have, they lie between these 3 4-hour candles. We have 1, 2, and 3. So whenever you're creating a trading plan, you have to understand that, okay, which 4-hour candle am I going to focus on? Am I going to focus on the third 4-hour candle, which is where you have your pre-London and London Open? Am I going to focus on the fourth 4-hour candle or the fifth 4-hour candle? Because that's the idea, because you're only looking to trade when there's volume in the market. Because trust me, whenever you're focused on, because, okay, here's the thing. You're only trading one 1-hour candle or one 30-minute candle. And we've talked about that in breaking down the high time frames and the lower time frames. But right over here, we're only talking about how sessions are going to influence your 4-hour time frames, how sessions influence your time frames. So whenever I'm looking for a trade, I'm looking at where the next 4-hour candle is going to go. If I see that I have consolidation happening on the second 4-hour candle, I automatically understand that, okay, if we have consolidation happening on the second 4-hour candle, maybe the third 4-hour candle is going to be the move. Maybe the third 4-hour candle will move price where it has to go. So you have to visualize how the third 4-hour candle is going to form. And then you try to understand that, okay, you know what, the third 4-hour candle, it has my pre-London and my London Open. So maybe there's going to be a lot of volume coming in from these time frames. So I have to be ready to anticipate where the 4-hour candle is going to go. If there's no volume during these times, then the 4-hour candle basically isn't that big of a candle. Then you're trying to see that, okay, we probably consolidated, or let's say we had volume during Asian 4-hour candle, and then we had no volume during this time, and then all of a sudden, the pre-London and London Open 4-hour candle starts to consolidate right here. So maybe we're going to have volume in the fourth 4-hour candle, which falls in pre-New York and New York Open, right? So whenever you're trying to see when you're going to trade, you're trying to anticipate where the 4-hour candle is going to go depending on which session you're looking at. So whenever you're trying to make a trading plan, or whenever you're trying to see that which time you're going to trade, you have to focus on just one 4-hour candle. That's what I've done. That's what I've done for the past 5 years, 6 years, only focused on one 4-hour candle. And we've talked about this a lot of times. Whenever you have a candle moving, there are billions of dollars moving in that candle. So your job is to just scratch the surface of that candle. Hope this helps. We're going to move on to the next section. Take care. What's up, everybody? So in this section, we're going to talk about zones and ranges, right? Now, a lot of people, they confuse the difference between zones, what are ranges, how big should a range be for you to take a trade? If we're within the range, what should we do at that point? If price is at a probable zone, what's going to happen? Will that zone break or will that zone be respected? Stuff like that, right? And it's very, very important because once you see these situations happen in the charts, you start to second guess yourself. You start to think that, okay, maybe this is going to work, or if it's not going to work, or like, price has left a zone, or price has left a support or resistance. Should I take a buy over here, or should I take a sell over here, or should I wait for a retest, right? So the biggest question is, if we're in a zone and you have a range in front of you, or like, if you have a clean range to the left-hand side, the biggest question is that, should I wait for a retest? Or should I just do an impulse entry for price to go wherever I think price is going to go, right? And a lot of people get confused in those different scenarios, right? So we're going to talk about that, and we're also going to talk about when zones are basically broken, like what times you have when zones are broken, when are they respected. So let's get to it. So first things first, let's say we have a resistance, right? And this is your regular resistance right here. Now, when you have a resistance, you have to understand that a resistance is not a specific price, right? Because when I first started in the beginning, I would look at that and I would say, okay, you know what? It's a specific price. Let's say if you're looking at pound yen, I would say, okay, you know what? This is basically, let me just do this right here. I would say, okay, my resistance is at 160. 500, right? Ideally, it's not at 160,500 because this area you see, these are collection of prices, right? This could be between 160, let's say 160, 450 to 500. It's not always 160, 500. So whenever you're taking a look at charts, whenever you're trying to see where your resistance is, it's not a specific price. It's the range of prices. So that's what your resistance is right there. It's a range of prices, right? So that's your resistance. Now at the same time, let's say we have a support area down over here at this point, right? So you have your resistance, you have your support. Now, a zone, right? So this is your zones. A range is the distance between two zones. That's your range. So the distance between these two zones, let's say this is a distance of 30 pips. This is your range right over here. A range is going to tell you that whether or not you're going to have a higher probability to win a trade or not. That's what the range is going to tell you. Now, for me, if I like to take a trade, I like to have a range of about 30 pips, right? This could be, let's say, for example, if price made a high right over here, price came down, created support, and now you could say that, okay, like, you know what, maybe this range is 10 pips. If you have a 10 pip range and you want price to retest the high at this point, this is a very, very small range. It's not going to work out for you, right? So we're going to imagine that this 30 pip range doesn't exist, and we're going to say that, okay, like, you know, maybe if this is a 40 pip range, if this is a 40 pip range, this is going to be a much better idea for you to execute on a trade. Now, let's start from the very, very basics, right? So you have two zones and you have a range in the middle, okay? And for better explanation, let's say this is a 40 pip range. Ideal range. For me, an ideal range is between 30 and 40 pips. Sometimes, you know, like I can execute on a 20 pip range or a 25 pip range, but it all comes down to experience. It all comes down to how many times have you seen certain things play out in the market, right? So in this case, we're only going to take a look at a 40 pip range. Let's say your range is 40 pips. Now, for example, now let's say you have a candle and like, this candle is closing bullish here in this range. Now, if a candle is closing bullish in this range and you got a 40 pip range, and if you're saying that, okay, like, the next candle has a higher probability to continue up towards our resistance zone, the best opportunity is going to be to anticipate the next candle to wick down without breaking this low and to continue pushing up. Even though this is a 40 pip range, understand this one thing. Now, I hope people are making notes. Understand this one thing. If you have a 40 pip range, it's not always that price will reach to the opposite end. It's not going to happen all the time. Right? Which is why whenever you take a trade in a 40 pip range or a 30 pip range, you are securing what you can secure, like, 15 pips, 20 pips, 25 pips. You can easily secure in this 40 pip range, no problem. But also note that the candle is near this zone. The closer the candle is to a zone, the better the probability that you can have a winning trade, right? What I mean by that is, like, if a candle leaves the zone, let's say you have a candle at this point and the candle leaves the zone, the further away a candle moves from a zone, the higher the probability that it may come down to do a retest. Now, there's one thing that I've seen traders do all the time, whether you're coming from YouTube or you're already in market fluidity. I've seen this thing, where people do this all the time. You're going to have a candle closing away from a zone. Let's say that this zone here doesn't exist. Let's say we have clean candles to the left-hand side, and we've moved further away from the zone in a manner that a candle closed like this, right? Well, now what guys are going to say is that, okay, like, since we have volume at this time, we're going to anticipate the next candle to wick down, break this high, and then continue to push up. Now, on paper and theory, this looks good. Right? This looks good, but the probability of price moving further up, it becomes lower than the probability of price retracing to create support, unless you have a lot of volume, right? Unless you're running at pre-London, you're running at London Open, unless you got a lot of volume, it's going to be a very low chance that price will continue to push up. Most probably what's going to happen is that price may move up, and then it may continue on pushing down. This has happened to a lot of people in the past as well. Like, price may do something like this, like moves up, breaks the high, comes back down, and closes a bearish candle like this. And now you're, like, left holding the ball on the losing side, right? So whenever you have a candle that's breaking outside of a zone, and it's like, I would say maybe if it's like 15, 20 pips away from a zone, there's a high probability it's going to do a retest. I'm not going to execute on that candle. I may execute when price comes down to do a retest. So ideally, what I would want to see is that whenever you have a candle that's breaking above a zone, it needs to be closer to the zone, right here, okay? Because, listen, the closer the candle is to the zone, the higher the probability it's going to leave that zone, especially if that's a 30-minute time frame. 15-minute depends on the situation, depends on the amount of volume. 1 hour time frame, 30-minute time frame, they're awesome. If you have a candle that's closing at a zone, like a 30-minute zone or a 1 hour zone, it has a higher probability to leave that zone, or it has a higher probability to reject that zone. For example, let's say like we move back to our resistance at this point, right? And this is your 40 pip range. And if price comes up, your price is at at a resistance at this point, and we're basically creating a resistance right over here. If we're creating a resistance right over here, and this is a 1 hour zone or a 30-minute zone, then there's a high probability it may continue to push down. There's a high probability. Now, I'm not going to say that this is valid in a range. Even if you have a range, you have to take this trade when there's volume in the market, like pre-London, London Open. And this range also has to be like a 40 pip range, like a 35 to 40 pip range. Sometimes we can have a 30 to 40 pip range, but price is just not really moving. Candles are not that big enough. Sometimes you can have, a 25 pip range. If you have a 25 pip range, and you're taking a sell right here, what are you trying to get? If this is a 25 pip range, let's say an average spread is like 1.5 pips or 2 pips. Now you're left with a 23 pip range. 23 pip range. What are you trying to get? 10 pips out of it? No, man, nothing. It's not going to work like that. Now, another thing that I see people do all the time is that, okay, so let's remove this area here, right? Let's remove this, and let's remove this, and let's do something like this. You got a support area, you got a bearish kind of closing right here, you got a big, okay. The reason why don't take a sell within the range when the candle is in the middle of a range is because when a candle is in the middle of a range, there's a 50-50 chance. There's a 50-50 chance whether the candle is going to go up or it's going to go down. There's a 50-50 chance because now we're in the middle of a range. And even if this is, let's say it's a 45 pip range, right? If we're in the middle of a range, even though you can say, okay, you know what, hey man, we got a 20 pip range to move to the downside, 20, it's still in the middle of a range. You have to look at probabilities, right? Probabilities. Probability dictates that there's a 50-50 chance that the next candle may move up or it may move down. There's a 50-50 chance. So we only have to execute when the probability is in our favor, right? Let's say we are right over here. We are right over here, right? It's closer to a zone right here. The closer price is to a zone or the closer candle is to a zone, there's a higher probability for price to reject that zone or for price to leave that zone, right? So now, whenever we're going to talk about sells after resistances, we're talking about sells after resistances in downtrends. Whenever we're going to talk about buys at supports, we're only going to talk about buys at supports in uptrends. Perfect. Hopefully we're all making notes, right? So this is the basics. You got your zones and you got your ranges. Whenever you're trying to take a trade, you have to make sure you have a big range, like a 30 pip range, 40 pip range. You know, on gold, you can easily get a 40 pip range. These days, there's a lot of volume in pound yen. You can get an easy 40 pip range, 30 pip range. As you go down ranges, like let's say as you go down towards, like a 25 pip range, for you to get that trade or for you to get that move gets a little bit harder, because then you're anticipating the candle to move like 10 pips, 15 pips, 20 pips if you're lucky. So that's what happens right there. So whenever you're taking a look at your ranges, first things first, you need to see how much of a range do you have. If you have a 40 pip range or a 30 pip range, you're like, okay, perfect. I got a 30 pip range and I can execute a trade in that range. Okay, awesome. Second is, where is the candle closing? Where are you taking an entry? Are you taking an entry near a zone? Right? Are you taking an entry near a zone? Or are you taking the entry once price has left the zone? If you're taking an entry when price has left the zone, the chances of you winning the trade is 50-50. And we're not in this business to make money on a 50-50 chance. We're in this business to make money where the probabilities is in our favor, right? So always you have to make sure that you're trying to execute when price is near a zone. Because then when there's volume can push price down. Or from here, volume can push price up if we're near a zone at this point. Right. Now, zones and ranges, they may seem simple, but when price is moving, FOMO gets in the way, over-trading gets in the way, revenge trading gets in the way, we really need to understand, we really need to control that. Those feelings are really going to fuck you over in the markets, okay? So you have to understand, whenever you're taking a look at the charts, you have to measure how much range do you have. Is it even a tradable range, right? If you're looking at a tradable range, do you even have clean traffic to the left-hand side? It's very important to have clean area to the left-hand side where price has moved easily to the left-hand side in the past, and now you can expect price to move there easily as well. So again, I'm going to reiterate everything, right? First things first, you need to know where your zones are. Once you have your zones, you need to understand how much range do you have between those zones. If price is going to break resistance, do you even have enough range for price to move in? Because if you have enough range for price to move in, that means you can grab a part of that move. Not the whole move, the part of that move. If you want to grab the whole move, then you're maybe, you're letting a runner run. You're letting like, 10% run, 20% run, 15% run, whatever that number is. words, you're letting those runners run, but initially you're securing what you can secure in that range. Right now, study this, make it a habit. Whenever you're trying to analyze charts, make it a habit to plot out your zones and then measure the range. Is there enough range? And for the first few months, just sit and watch. Sit and watch to see how price moves between those zones. Thank you. What's up, everybody? So in this section, we're going to talk about fake outs. Now, how do you define a fake out? A fake out is when price is consolidating, and then instead of breaking to the top side, it does break up, or let's say if it's breaking to the downside and it does break down, it just goes to the opposite way from the bottom up, or it goes to the opposite way from top to the downside, right? That's basically a fake out. Now, when do fake outs happen? Why do they happen? Can you really spot them? Can you anticipate a fake out? The first things first, you cannot anticipate a fake out. It's really, really difficult to anticipate a fake out. That's like the same thing saying that, let's say you're playing soccer and you're like, okay, will this guy dodge me or will this guy fake me out? There's no way it's going to happen. You're never going to be able to fake that, anticipate that. Now, when do they happen? Fake outs normally happen after price is consolidating, right? So let's say you have a session. Let's say you have a pre-London session and you notice that price has been ranging during pre-New York, or let's say like, London Open and pre-New York, and now you're saying that, okay, like, you know what, we've been ranging since London Open and pre-New York, maybe we're gonna have volume at NY Open. And at NY Open, let's say at consolidation, price breaks down, and then price just goes the opposite way, right? That breakdown, that was the fake out, because price tried to move to the downside, but there was something there that made price come back in the range, and then price went the opposite way. That's a fake out. Fake outs happen all the time, right? So we need to understand this one more thing. Price will always move either up or it's going to move down. We as traders, we need to identify that what's the probability of price moving to the top side or price moving to the downside. Sometimes while price is consolidating, it's going to continue pushing bullish. And sometimes our price is ranging, it may continue to move bearish. So what we're going to do here now, we're going to pick up a few, they're basically just two variations of fake outs, right? There's a bullish fake out and there's a bearish fake out. So we're going to talk about those right now. All right. So first of all, we're going to talk about the bullish fake out, where price breaks to the top side, comes back in the range, and then starts going to the bottom side, right? So we have a resistance, and we have some sort of a support down here. Right now, for example, we have a candle that's basically bullish at this point. We're bullish at this point, and you're like, okay, you know what? It's perfect. The next candle goes bullish, we break out of the range. Now we've broken out of the range. Now once we've broken out of the range, we're thinking that, okay, now let's say price has been consolidating for a little while over here. Once we've broken out of the range, we're thinking that, okay, now there's a higher probability for price to continue pushing up. Now either you're looking at an impulse entry or you're looking for a retest. So let's say, for example, for simplicity, we're looking for price to retest this broken resistance. So what's going to happen is that we may see another bullish candle go up, and after this we see a bearish candle start to push down in such a manner. Now when we see a bearish candle start to push down, we're like, okay, perfect, we've broken outside of the range, now there's a high probability for us to create some sort of a support, and then you see another bearish candle that forms at this resistance. Now after this, you see that, okay, we have a bullish candle forming at this point. Now the fake out is going to happen when there's going to be volume in the market, right? So let's say, for example, this is pre-London, or this is, London Open, or pre-New York, New York Open, NYC, whatever time of volume there is, we've studied that. You're anticipating the next candle to either break this high, or you're trying to take a buy at this point for price to go up, right? So let's say you're actually taking a trade. Now, instead of moving up, what we see is that a candle forms and it closes back inside the range. Now, when you have a candle closing back side of the range, now this is going to be more prominent on a 30-minute time frame, not on the 15-minute time frame. 15-minute confirmations are weak confirmations. So I like to look at this on the 30-minute time frame, 1-hour time frame, 4-hour time frame. This also happens on a daily, weekly, stuff like that too. So let's say this is happening on the 30-minute time frame, right? You have a candle closing back in the range. Now this support, right, ideally becomes your resistance at this point. Now, there are two variations this can happen at this point. Now, if you're anticipating volume, there's a very, very high probability that the next candle can retest this area and then start to push down within this range. Now, if you're going to trade this range, you need this range to be at least, I would say, 30 pips. This range has to be at least 30 pips for you to take this fake out trade. Now, this whole move to the top side, this is what we call a fake out, right? The reason why is that price tried to move up, right? Price broke out of consolidation. It tried to move bullish, but it closed back in the range. So when you have a prominent time frame, like a 30-minute time frame closing back in the range, after breaking out, there's a very high probability that it's going to continue pushing back down to the bottom of the range. And if there's more volume, we could also see price further dropping outside of this range and actually continuing to push down if there's more volume, right? So these things will happen. Now, the main thing to understand here is that price actually tried to break out of the range, right? This is very, very, very important. So whenever you're trading, you have to constantly talk to yourself. If you took a buy right here, right? Let's say that you took a buy right after you had a candle closing bullish, you took a buy, and like instead of price moving up, price went back in the range and closed bearish. Now your buy is nullified, right? You're getting out of that buy. You're no longer holding that buy because now you understand that, hey, maybe this move up was a fake out, right? Because now we have a candle closing back in the range, so I should better get out of that buy. And as you move along the market fluidity concepts, you start to become fluid enough to understand that, okay, maybe we're not continuing to move up, so maybe the dynamics of the direction of the market has changed, right? It's very important for you to read the candles, right? So when price comes back in the range, this is where you're saying, okay, like, you know what, we've closed back in the range. If the next candle breaks this low, this is more discussed in the impulse entries. If the next candle breaks below this low and we have a 30 pip range, I think there's a very high probability for price to continue pushing down in the range, right? So remember I talked about there's going to be two variations. This was the first variation. Now we're going to talk about the second one. Right, it's very important we 100% totally understand how price is moving, how price is acting for us to really take advantage of these, like, fake outs. Now, for example, instead of price closing like this, we have a bigger candle that closes in the range. Right? Now what's going to happen? Once we have a bigger candle closing back in the range, if you're looking for an impulse entry right here, what we talked about in ranges, in way to take a trade, whether at support or resistance, we understood that if you're trying to take a trade right here, as the next candle wicks up and starts to break the previous candle's low, is this a good entry right here? Is this a good entry in the middle of a range? Absolutely not. This is the worst possible entry you can take because essentially you're taking a sell while price is in the middle of a range. So even though if this is a 30 pip range, your tradable range is maybe like 10, 15 pips. What are you going to do with this, right? You can't do anything with this, right? Because your range is essentially smaller now. 30, let's say like 15, 10 pips, like if you factor in the spread as well, right? So it's not enough. So at this point, what's going to be much better for you to look for is for a possible retest and then a continuation down. Because if this is a 30-minute time frame, we already tried breaking up, right? Did that work? No, it didn't work, right? So there's an 80% probability now we will continue pushing down to the bottom of the range. Now, also remember, there's a low probability that price may continue pushing up. Right? We have to keep that in mind. It's not all the time the price will continue pushing down, because we always talk about in probabilities. There's a very high probability we may continue pushing down. Like a lot of traders have traded these fake outs, they've been successful at it, but also there's a small possibility you have to understand that price may start to continue pushing up. Right? And also remember, one very important step, if you're trying to trade this fake out, right, and only trade and execute on the fake out if you did not execute on the buys. Now, how would you know this is a fake out? You wouldn't know. The only way you're going to trade on the fake out is that if you have missed your execution on the buy. Right? For new traders, if you executed on the buy and price comes down and you know that this is a fake out and you studied in Smart Roger Concepts that this may be a fake out, don't execute on it. Just watch it play out, right? You watching how price moves, that's going to be your biggest development as a trader, 100%. Right? So always understand there has to be range for you to take a trade, right? And this candle closing down here, you have to wait for a retest. If the candle, let's say the candle closes back in the range like this now gives you enough range to take a trade. Right? It gives you enough range to take a trade. And if this is a 30-minute time frame, there's a very high probability it's going to work out. Right? So this is very important. Look at these examples in the charts. In the past, you will see that there's a very high probability price has moved in the opposite direction. Now, a lot of people may know some stuff, but going over these basics, it's going to rekindle something. It's going to light up that spark or light up that bulb in your mind, and you're going to say, oh, you know what? This is something I missed, or this is something I didn't factor in while trying to trade fake outs. Now, we're going to talk about the bearish fake out in this scenario. Now, it's also true for the opposite. Let's say we have a resistance up over here and we have a support down at this point. Now, let's say, for example, we have, bearish candles that start to break down all the way from the top hand side. We're starting to break down on the bearish candles. Now, if we're starting to break down the support and you see, okay, like, you know what, there's a probability for price to go down, and now what we see in this bearish fake out is that we have a retest and candles start to print down. Instead of continuing to the bearish side, we see sometimes, a candle that forms like this, a rejection at this point. So whenever we see a rejection below a support, or let's say price started to move down and now we see some sort of rejection, there's a probability that price may do a retest at this point and then continue on pushing down. But instead, what happens is that you have a candle that instead of going down, we close back up in the range. Now, this is the opposite of what happened in the bullish fake out, right? In this bearish fake out, there was so much volume that price broke below support, right? We closed below support, and we had confirmations that now we may have a retest to continue down, but instead of a retest, price closes back in the range, right? So whenever we're closing back in the range, and we do understand that this may be a 30 pip range or even like a 40 pip range based on a 15-minute time frame or 30-minute time, especially on a 30-minute time frame to a 1-hour time frame. If this is a 30 to 40 pip range, this is a perfect opportunity for price to continue pushing to the opposite direction. Because again, price tried to break down, it couldn't maintain its bearish move, so it closed back in the range. Now visually, what we're anticipating is for the next candle to wick down and continue pushing up in this range, right? This is the most simplistic form of a bearish fake out. Like whenever you have a bearish fake out, there's a very high probability the price may push in the opposite direction. And as we continue up towards the resistance area, there's another very high probability that with volume, we can continue breaking up. And this is where the trend can continue to push up. Now, another scenario in this, which happens a lot of times, is basically, let's say that we have a candle that closes within the range, right? It closes somewhere in the middle of a range. Now, whenever a candle is closing in the middle of a range, this is not the right time to probably take a trade at this point because we're closing in the middle of a range. What are you going to do in the middle of a range, right? You have to identify what probability there is for price to move up and what probability there is for price to move down. There's a 50-50 probability that price will either move up or it's going to move down. And as we've discussed in the previous lessons, that whenever you're trying to take a trade, make sure your entries are taken near to the zones, right? So in this case, there's probably, if we're following perfect price action, perfect market structure, there has to be some sort of a bearish move down. We create some sort of a support. And if there's volume, we may continue to push up. Right? But this is not the ideal state to take a buy in a bearish fake out. Because essentially what's happening is now your probability of price moving up comes down from 70% or 80% to maybe 60%. Right? Because if this is a 30-minute time frame, we've created a resistance at this point, right? So this is where complications happen. So whenever you're seeing a setup form, let's say a fake out setup, for me personally, I want to see something perfect formed, right? And these things also do happen. Something perfect is going to be something like this. That's it. That's all what I want to see. Because if I'm trying to take a trade at this point, on the next candle right here, my stops are below the 30-minute candle, and then I'm not expecting this new candle to break the low of the previous candle. I'm just expecting it to continue to push up. That's all what I'm expecting it to, right? Now, when it comes towards managing risk, we have to go over the risk management section. We manage risk on the 15-minute time frame, when we're taking on 30-minute candle trade and so on and so forth, right? So fake outs, they do happen. We have to see if the candle confirmations are there. And we've talked about this a lot of times too. Make sure that the trade you're executing on or the candle setup you're executing on is exactly how you picture in your mind. Because most of the times, those are the cases that do work out. All right, as simple as this sounds, it's actually that simple. The only problem is we have to just wait. We have to wait for candles to print something that we can recognize. Because when we can recognize the pattern, when we can recognize a certain pattern or a certain way the candle is closing for us to actually execute on a trade, then executing on that trade becomes much more easier because we know in our mind that we've seen certain things happen over and over and over again. And also there's a higher probability for certain things to play out. But at the same time, we have to understand probabilities as well, right? Now, these setups, like these setups we talked about, there's a higher probability for them to play out. There's also a lower probability they may not play out. So that's where your psychology comes into play, and we've discussed this all over again as well, that whenever you have that lower probability playing out, you have to manage risk. That's a part of trading. That's a part of your trading plan. That's a part of your risk management strategy. So whenever you're fronted with a situation where that small probability of a trade not playing out, that's when you got to mitigate risk, right? But in the higher probability, like 70% chance, 80% chance, things are playing out, and you do see fake outs happen, that's when you're going to say, okay, you know what? We're going to continue with this, and we're going to execute on this. Again, fake outs, they're complicated, right? They're complicated. You can't anticipate a fake out until and unless a candle really closes in that direction, right? So in the start, what I'm going to say is just like sit back and watch on the charts how fake outs have played out. If you were able to recognize them, if you were able to anticipate them as candles close back in the range, right? Go over the previous charts, go over the 30-minute charts, 1-hour charts, and look at times of volume. Look at times when price was ranging, and during the time when price was ranging, look to see whether there was a fake out. If there was a fake out, look at the candles and really ask yourself that where could you have executed a profitable trade? Now, you're not going to get better in a week or in a month. This would take like 3-4 months of deliberate effort and deliberate practice in seeing the same things happen over and over again. Awesome. That's all for fake outs. We're going to see you in the next section. Now, This may seem very simple. Buy support, sell resistances, right? Very simple idea. But you have to understand, when are you actually trying to buy supports? When are you actually trying to buy resistances? So we're going to talk about two things. We're going to talk about trend trading, right? Trend trading. And we're going to talk about counter trend trading, and these two concepts are equally as important. So first, we're going to go over what's the trend, how you're trying to gauge market structure, how you're trying to gauge candles movements, and then we're going to talk about counter trends, because a lot of times what happens is, like, for example, price starts to rally, and price is rallying, amazing, perfect. What traders like to do is they're like, okay, you know what, price is rallying, and I see a resistance to the left-hand side, and because of that resistance, we will reject that area, and then you take a sell. So when you take a sell, essentially what's happening is you're trying to take the opposite trade of a price that's moving up. Or if price is moving down, like we say, falling knives, if price is moving down, you're like, okay, you know what, I see a support. And based on what I've studied is that we're reaching a support, there's no confirmation for buys, but I see a support, and I'm going to take a buy right there. And when you take a buy right there, or you take a sell all the way up over here, price starts to rally up. Or if you take a buy, price starts to keep on dropping down. And this used to happen to me as well, because we're trying to counter trend. We're trying to catch that wick trade. We're trying to catch that perfect entry to have a winning trade. So we're going to go over that. First, we're going to go over trend trading. Next, we're going to go over counter trend trading. The concept is very similar, very simple. This is why it's smart Raja concepts, very simple concepts. But the only issue is you have to wait for the candles to print the way you should have them printed, right? So let's talk about that. All right. So what's the basics of a trend? Now, a lot of people know this as well. A lot of people have even studied this through our live streams, through our videos on YouTube, stuff like that. But it's always a good idea to go over the basic concepts, because the basic concepts are something that build your foundation, and a strong foundation is what you need to be profitable in the markets, because guess what? Markets are not complicated. Markets are just as complicated as you're going to make them. So we're going to go over that right now. So the basics of a trend is this: price moves up, we create a high, price comes down, we make a higher high, price comes down, we make a higher high, and so on and so forth, right? That's how price moves. Now, when we're taking a look at this from a candle's perspective, right, what happens? You have a candle that prints bullish. Now you want the next candle to move up. Next candle should respect the low of the previous candle right over here. So now we have a higher low and we have a higher high. Now the next candle has to respect the low of the previous candle and continue to push up. So this is the basic idea of price moving up, making higher lows and higher highs based only on candles. Now, we're going to go into trend trading. If I can find my magic eraser right here. Okay, found it. Awesome. Now, trend trading is really simple. You identify the trend, and the way you identify the trend is basically you see where the higher time frames are moving. Now, let's say, for example, you're looking at the daily time frame, and the daily candle, you see that, we're pushing up over here. You're like, okay, daily candle has to move up. You look at the 4-hour candle, and, maybe the 4-hour candle is, somewhere situated like this. We have a candle like this. We have a 4-hour candle forming like this. And you have clean range to the left-hand side. And you're saying, okay, the 4-hour candle is also bullish because we're creating support, okay? Now, the basic idea of trading a bullish trend is that you're waiting for price to create support. Make a note of that. To trade a bullish trend, you have to wait for price to create support. That support could be on the 4-hour time frame. That support could be on the 1-hour time frame, 30-minute time frame, 15-minute time frame supports. They are okay, but the problem with the 15-minute support is that the confirmation is weak. It's a weaker confirmation. So that's why we're looking at the, I would say ideally, the 30-minute time frame or the 1-hour time frame, right? So you have to look for supports on the 30-minute and a 1-hour time frame. Now, let's say that we are in a bullish trend, right? So we're going to remove this and we're going to draw up some proper examples right here. But this trend is also identified on the daily and the 4-hour. So if you have made up your mind that the 4-hour is bullish and there's a high probability 4-hour can move bullish, you have to wait for supports. The supports are formed on the 1-hour and 30 minutes. So let's say, for example,
Okay, so let's say, for example, we have a bullish candle moving up. This is a 30-minute time frame, moving up, moving up, moving up. We are moving up right here, okay? Awesome, we moved up at this point. Now, we have formed a resistance at a zone on the 30-minute time frame. Now, if you've gone through the section of zones and ranges, you may look at this and say, okay, you know what, Raja, based on that virtual class we did, prices at a 30-minute zone, and 30-minute zone is a very strong zone, so there's a high probability it can go down. Why can't we take sells? The reason why you can't take sells at this point is because, let's say you take sells at this point in a heavy bullish trend, and you have pre-London volume, London open volume, New York open, NYC, whatever that is, but the time is when there's a lot of volume, right? So let's say you take a sell. What can happen is, if you're not focused on the trend, is that the next candle can break this high right here and continue pushing up. That's something that can happen. So whenever you have a bullish trend, you're not looking for sells. No, you're looking for buys at this point. And we're going to talk about the condition for sells as well in a bullish trend. So let's say you have, like, a rejection right here at this point, and now price starts to go down. We're moving further down. We're moving further down right here. We're moving down here. And let's suppose the trend is coming all the way from the bottom, and now you have a support form, right? This is a support form. A support is formed when you have a bullish candle closing after a bearish candle, right? The only forms of supports you're looking at are in uptrends. Always remember this all the time. Trend is your friend. Don't trade in consolidation unless you have a bigger range, right? And when in a trend, wait for supports form. These supports could be in the, these supports could be a part of your 30-minute time frame, your 1 hour time frame, right? The higher the time frame, the better. But the 30-minute time frame, strong supports. Now, first things first, right? Your support is formed. You waited for the support formed in an uptrend. Perfect. You got your support formed. Now, at this point, you're measuring the range, right? Let's say this range on the 30-minute is about 30 pips. You got a 30 pip range. You got a support formed, and you're like, okay, you know what? I have enough range to take a trade for price to retest this high. Now remember this one thing. Whenever we're in a trend, whenever price is in a trending market and it makes a high, there's a high probability, there's an 80% probability that that high is going to be retested. And how is that high going to be retested? If we're going to create support. So if we're creating support at this point, there's a high probability for price to continue pushing up if we're creating a support, right? And your stop is below this candle. That's it. That's all what you're looking at. It's a perfect example. This happens all the time. All the time it happens like, clockwork when there's times of volume. So whenever you have an uptrend and you're anticipating 4-hour candles to go bullish, you're anticipating the daily candles to go bullish, you're waiting for 30-minute or 1 hour to create support and to continue pushing in the trend direction. That's where you're only trading the bullish trend. Now, sometimes you can have different variations, and these variations could be like, you can have a bearish candle forming like this, and you can say that, okay, we got a bearish candle closing with a small body. This means that maybe the move pushing down, the volume of bearish candles moving down is decreasing because now you have a smaller body. Because always remember, the candle bodies are going to tell you how much volume there is in the market, right? So you have a bigger body, boom, you got a small body at this point. What are you trying to do at this point? Are you trying to wait for a support formed, or are you trying to take an impulse entry as the next candle breaks above this high without breaking this low? You're taking an impulse entry at that point, right? Because sometimes, if you're new, you're going to say, okay, I'm going to wait for the support form, and you're going to wait, and as you're waiting, candle starts to pump up at this point, and candle closes like this. And now you're like, oh man, I knew price is going to go up. How did these people take impulse entries? I don't understand this. So the more you see price move up without you being not in the trade, the more you're going to learn about impulse entries, because the more you're going to see, because when I first started about impulse entries, I would see price move against me all the time. And I would say, okay, why is price moving against me? And I'm not in that trade. How could I have been in that trade? So I'm like, okay, if trend is where price, makes a higher high and a higher low and all that stuff, and if this candle is respecting this previous candle's low, which means it's making a higher low, and if it's breaking above this high right here, this means that it's making a higher high. So if I can take an entry as it's breaking the high and have my stop below this candle or even this candle, maybe, and if a trend is up and there's volume, maybe I have a higher probability of winning that trade with an impulse entry. Make sense? So that's how this whole impulse entry thing came into being, like by watching price move when you're not in that trade, right? So go over these things, right? Go over this virtual class again. Now, let's say we have created a support, right? So we're going to talk about this. So let's say we've created a support right here. Let's say we've created a support right here. Now we have a support at this point. Now, okay, let me just bring this up here a little bit.